Warren Buffett built one of the greatest fortunes in history by reading annual reports of public companies. Not news stories, not analyst reports, the actual filings. Here's what's wild. Sellers have access to the exact same intel. Every public company you're going after has to file one. They're free, they're public, and they contain more deep intelligence about the accounts that you're trying to sell into than anything your marketing team could ever put together. But almost nobody in sales leverages them in the right way. Pay attention to the hedging. Most language in a 10K is carefully lawyered. So when something in the MD&A is stated plainly and directly without qualifying language, that's a 5-alarm signal. That means that management considers it important enough to state without cover. Section 2, management discussion and analysis. Here's what you're looking for in the MD&A. What initiatives are explicitly named? Not implied, named. If the CFO writes, "We are prioritizing reduction of customer acquisition cost in the second half of the year," that's a budget conversation waiting for the right seller to show up. Here's another thing. What's underperforming and how managing is talking about fixing it. The language they're using here is the language you want to mirror back to them. When they hear people from the outside world, definitely including sellers, talking about the things that are top of mind for them, they're going to lean in much more than any seller who's saying, "Hey, I got a widget. Let's talk about what my widget could do for you." Forward guidance. What commitments is management making to analysts and investors? These are the targets that executives are being held to. Show up knowing these numbers, and you'll have a different conversation than everybody else in their calendar this week. This is a section where you'll find language executives are already using internally. Use it back to them, and you'll instantly sound like a peer instead of a vendor. Section 3, the financial statements. Most sellers skip this section entirely, and that's a huge mistake, and I'm going to tell you exactly why. A Gartner study found that CFO involvement in B2B purchase decisions above $1 million has increased over 70%. And the primary reason CFOs block or slow down deals isn't because they don't believe in your solution. By the time it reaches their desk, it's usually already cleared of internal merit reviews, like, will this solution work for us? What kills deals at the CFO level is commercial misalignment. The wrong payment structure, the wrong contract terms, a CapEx commitment in a year when the company only has OpEx budget. A lot of time it's timing and financial fit. The financial statements tell you which of these landmines are in your path before you step on them. The income statement. 3 numbers matter here. Revenue. The revenue trend over 2 or 3 years. Is it growing, flat, declining? This is going to tell you whether you're selling into a tailwind or a headwind, and that's going to completely make you adjust which direction you're taking your point of view. Gross margin trajectory. Gross margin is a flavor of profit. So if gross margin is compressing year over year, the company is spending more to deliver what it sells. That's a board level problem. If your solution can credibly protect or expand gross margin, you've got a conversation with the CFO, not a department head. Selling general and administrative expenses, or SG&A. Rising SG&A usually means investment in growth. Falling SG&A means the company's pulling back. Both are signals that change how you position the conversation. Balance sheet. One comparison, cash versus debt. A company who's in a strong cash position and manageable debt is thinking about growth and opportunity, how to go bigger, faster. They're looking for acceleration. A company with low cash and rising debt is in protect and survive mode. Every purchase gets scrutinized. Your commercial structure needs to reflect that reality. Your point of view is going to be more about, here's how we can help you save money or do more with less, with a small investment that will repay itself before the next time you're going to report to the street. The cash flow statement. This one cannot be faked. Revenue can be managed through accounting, but cash, either it came in or it didn't. If operating cash flow is positive and growing, then the core business of the account that you're selling into is healthy. If it's negative or declining, something's wrong under the reported numbers. So you should always be thinking about the frame that you can take with your point of view based on what's happening financially inside of the account you're selling into. When the numbers trend up, your conversation is about acceleration and growth. You're helping them get bigger faster. When their numbers are under pressure, your conversation is about efficiency. Help them do more with less. Know which conversation you're walking into well in advance. One more thing on financials, CapEx versus OpEx. This is one that most sellers never think about, and it quietly kills the deal or misses huge opportunities. How a purchase is classified on a company's financial statement affects whether a CFO approves it. A capital expenditure hits the balance sheet and gets depreciated over time. An operating expense hits the income statement immediately. So when a company has hit its CapEx ceiling, a seller offering a flexible subscription model has a structural advantage over a competitor who's selling a perpetual license, for example, even if the perpetual license is the better product. The subscription is a better fit into the financial architecture that the CFO has planned for that fiscal. Look at the balance sheet. Look at prior year's CapEx levels. Then ask your finance team or your champion inside the account how purchases like yours are typically classified. That one conversation can unlock a deal that would otherwise stall in procurement. Section 4, the business section. Most sellers read this section to understand what the account does. It's useful, but it's not the whole picture. What you're really looking for here is revenue mix by segment. What part of the business is growing and which are declining? That's a level of granularity that most sellers never go to, and if you do, you're going to be way ahead. Now, here's a caveat that's worth knowing. Some large companies, particularly in enterprise tech, deliberately limit segment exposure. They'll report under broad categories that make it hard to see where the growth is coming from. And that's a strategic choice by management to limit competitive visibility. If you encounter that, the absence of detail is itself informative. It tells you this company manages information as a competitive asset. But where segment data is available, it tells you something critically important. Which division or divisions are getting investment versus which are being harvested for cash. If you're selling into a division that's in harvest mode, meaning it's generating cash for the company, but it's not receiving growth investment, you're selling into a structural headwind, regardless of how good your solution is. Budget conversations will be harder. Approval chains will be longer. Knowing that going in might change your strategy for the better. Read the business section to understand where the company is placing its bets. Then make sure the conversation you're planning is with the part of the business is receiving investment, not the part that's funding everyone else. Section 5, risk factors. I want to give you an honest framing about this section because a lot of sales content overstates what the risk factor section can tell you. Risk factors are primarily written by lawyers. The SEC requires companies to disclose any factor that makes investing in them risky. What this produces in practice is a section that is deliberately broad and often somewhat formulaic. The legal team adds a ton of risks, not because the CFO is losing sleep over them, but because they need to be disclosed to protect the company. A 2019 MIT and Harvard study found that risk factor disclosures had become so standardized they'd largely lost predictive value for investors. The SEC issued guidance in 2020 specifically asking companies to make them more specific because so many had become boilerplate. So what's this section actually useful for? Hypothesis generation. Read the first 4 or 5 risks. They're typically ordered by management's assessment of severity. Ask yourself, does my solution address any of these? If yes, you now have a hypothesis to test in your outreach and discovery. Don't walk into a meeting and say, hey, I saw cybersecurity listed as a risk factor, so I assume you have budget for this. That's not going to land well at all. Instead, use it to formulate a question. Hey, I noticed you listed cybersecurity as a material risk. I'm curious, what you're thinking about that heading into next year? That's the difference between a conclusion and a hypothesis that can start a conversation. Executives respond to smart hypotheses. Risk factors get you from knowing nothing about the account to having an informed set of questions. The MD&A and financial statements are what take you from your questions into a point of view. Section 6, the intelligence layer that most sellers miss. Everything I've covered so far lives inside the 10K, but there are 2 more sources on the same investor relations page that'll sharpen everything you just read. Earnings call transcripts. The 10K is an annual snapshot. Earnings calls happen quarterly. That's where the CEO and CFO are speaking directly to analysts, explaining what's happening right now, what changed from last quarter, and what they're prioritizing in the period ahead. If something in the MDA feels vague, the earnings call will often fill in the specific detail. And the language executives use on earnings calls, the exact phrases they choose to describe the problems and priorities, that's language you can use in outreach to signal that you're paying attention at the right altitude. 8K filings, the real-time signal. This is one almost nobody talks about in sales. The 8K is a much more current report than the 10K. It's filed within 4 business days of a material event, like a leadership change, a restructuring announcement, a major new contract, a breach of a covenant, or an acquisition, all these kinds of things will show up in the 8K. While your competitors are waiting for the next annual report, you can be monitoring target accounts for material events in near real time. The SEC EDGAR database lets you set up an email alert by company ticker for any new filing. 5 minutes to configure and it's totally free. A new CFO filing means vendor relationships and spending priorities are back on the table. A restructuring filing tells you that the company has a specific dollar target for cost reduction already on record. An acquisition filing means integration complexity and redundant systems, and there's going to be a whole lot of decisions about how to rationalize all of that. Any one of these events is a reason to reach out with a specific, timely point of view. That's what separates proactive intelligence from reactive research. Section 7, turning research into a point of view. Here's the part that most sellers fall down on. They do all this research, they read the 10K, they pull the earnings transcripts, they build a slide deck that summarizes all their findings. And then they walk into a meeting and they lead with the research. But research is not a point of view, it's a briefing. And executives don't need you to brief them on their own company. If all you did was read the 10K, you'll go from knowing nothing to finding financial and operational signals. Building a point of view gets you from finding those signals to showing the executives why it creates a reason for them to act. Those are two different skills. The research is the entry fee. The point of view is what earns the meeting and earns the ongoing engagement. Here's what a strong point of view sounds like in practice. Okay, so let's talk about a weak version and a strong version. The weak version is, hey, I noticed your margin compression last year. That's just an observation if that's as far as you take it. The CFO's been in 4 board meetings about exactly that point. You're not telling him anything new, you're just proving you can read. The strong version sounds more like this. So I was looking at your recent results and your commitment to restore your margins by at least 25% by the end of the fiscal year. But based on the cost structure in your filings, all the obvious moves like the hiring freezes and the vendor renegotiations, that'll probably get you to 4 or 5 million of the way there, but that still leaves a gap. And I have some specific ideas on how we could help close the rest of that gap without touching headcount any further. A CFO that hears a message like that has got to engage, because you're showing that you understand their problem at the level that they actually think about it. Not at the feature level or product level, not at the use case level, but at the board commitment level. At that point, you're not a vendor anymore. You're somebody worth their time. That's exactly why these financial disclosures make this all possible, but only if you do something with it beyond surfacing the research. Now, I couldn't cover every nuance in this one video, but what I've given you is the framework, which sections matter, in what order, and how to turn what you find into something that actually moves the needle. If you want to go deeper, specifically on how to read financial statements fluently and build the kind of point of view that I described, I have a free financial fluency webinar that walks through all of this in precise detail. The link to register is the first one in the description below. So if you're serious about moving into larger deals with real executive access, that's where to go next. And if you want to see the best AI workflows for enterprise sellers right now, watch this video next.